All right, guys, and gals, we are going to continue our day. Dan Zugell is going to be our second speaker for the day. Dan is Dan the ESOP man. Such a great guy. He is the Senior Vice President of the Business Transition Advisors. And he is a specialist in financing, analyzing, designing, and implementing employee stock ownership plans, ESOP plans. Dan has been in the industry for a long time and started with MetLife. So many people started with Snoopy, Dan. It's so interesting. And anyways, Dan is just an expert in this. We were given his name by multiple people when we started talking about creating the Advanced Planning Center. So we're excited to have you here. Thanks, Dan.
Thank you for having me. I'm really excited. Thank you for the opportunity. Really do appreciate that. Get my screen going here. I'm assuming everybody can see my screen, so I'll make that assumption. Carla, tell me if I'm wrong. Well,
you're good. We got it.
Okay, perfect. First of all, shout out to my friends at both the St. Louis chapter of FSP. When I lived there, good friends, and my local chapter here in Pittsburgh. Thank you for the support. I appreciate that. And I love what you're doing here with this young, energetic leadership team. Thank you. Keep it up, folks. Thought I'd talk today a little bit about employee stock ownership plans. It ain't your daddy's ESOP anymore. A lot of current, in the last 10, 15 years, a lot of trends that are changed, the designs, the financing, everything is different. And with pending, tax rate increases and the different things on the horizon, ESOPs are, it's been said in Forbes online magazine that the 2020s is going to be the decade of the ESOP. And so it's great that we're talking about it to get ahead of the curve. So we're prepared to recognize the opportunities when they come by. So we're not going to drill down to every single tax law change since the history of ESOPs and codified in 1974. We're going to focus more on the practical side of things. What do they look like? Who do they look like? How do we do it? How are the major things that business owners are concerned about? What value do I get? Who's in control? What are the tax benefits? Some of those type things is what I'm going to primarily focus on. So for a lot of very, very, very smart people on this call, I'm going to take, when I describe how an ESOP works, I'm doing the in effect, not necessarily the technical aspect of it. I'm happy to do that. I could drill down. So you might say, he took a shortcut, and yeah, you're right. But for the purposes of explaining how they work and the basics and what the end result is, I think you'll like the presentation. Well, let's start here. What is an ESOP? What Vince Lombardi said, what, gentlemen, this is a football? Well, this is an employee stock ownership plan. That's what an ESOP is. People confuse it sometimes. They think it's an employee stock option plan. I have stock options at work. Well, that's nice. That's not an ESOP. An ESOP actually means something very specific. It's a retirement plan, just like a 401k pension plan, just follows the same section of the IRS and have to follow all the rules, discrimination, contributions, all those things have to be taken care of in an ESOP, which is one reason ESOPs aren't talked about enough, because there are some technicalities. We have to follow qualified plan rules, and some people don't like to talk about that. And those of you that do are a leg up on all your competition, I can guarantee you that. Because how many sessions have we gone to in our careers from attorneys, accountants, insurance companies, whatnot, where ESOP was barely a bullet point. Meanwhile, it's probably the most tax advantaged way to transfer a business. And so I appreciate you joining us on today's journey. I think this is kind of funny. I'm not going to actually read the quotes, but what other topic can I have a quote from Bernie Sanders and Ronald Reagan saying virtually the same thing, that they love ESOPs? And the reason both sides of the aisle really, really like ESOPs, they come at it from different reasons, but the end result's the same. The one side of the aisle tends to like the workers getting shares in the company where they work. They work hard, they built the company, and they help the owner build the company. They deserve an equity stake in the business where they work. The other side of the aisle says, hey, that's great. We love employees and people with independent wealth, because those are less people we're going to have to take care of on the government safety nets. And the more tax benefits we give businesses, the more they grow. They hire more people, they pay more wages, they expand, they keep jobs, which is one of the biggest concerns of an ESOP, why both parties love ESOPs. It keeps jobs. It keeps it in the communities. And some of these the smaller the community you get, the more important it is for that 50-person machine shop to keep people employed. That shop goes under, they sell to a foreign entity or another state, those jobs pick up and move many times. And that's what ESOPs are partly designed to prevent. Now, there's some tremendous power of employee ownership for the employees and for the company, of course. ESOP companies are typically 4 times less likely to lay off people during a recession. That was in the 2008 recession, and COVID's proving the same thing. So just a lot more stability. Employees receive considerably higher wages compared to the same employee at a non-ESOP company. But that third bullet point there is kind of my favorite. Employees at ESOP companies average 2.5 times greater total retirement accounts than the same employee at a company without an ESOP. 2.5 times the retirement benefit. So from a financial advisor standpoint, one ESOP rollover, because it's qualified money, one ESOP rollover is worth 2.5 non-ESOP rollovers. Just something to think about in who you're targeting and talking to and what type of companies. All right, here's an ESOP candidate profile. Let's get this up. Let's talk about this up front briefly. So as we talk, you can kind of think of in your mind, who do I know and who would this be a fit for? Because we've got to set some parameters here, because there is expense to setting up an ESOP and there is expense to maintain an ESOP. And so, and some other compliance reasons, you need a company of a certain size. We generally need a company worth about $10 million or more. That's about 2 million of adjusted EBITDA, just a ballpark back of the envelope. And adjusted EBITDA, it's net earnings, and you add back depreciation, amortization, you normalize some personal things that are running through the business. They probably shouldn't be, maybe some owner salary. You add all those things up. If you get to about the 2 million mark, you're probably the size of a candidate for an ESOP. And we need about 25 or more employees to make it work. Now, these are just guidelines. This is kind of the minimum. We could go a tad lower, but generally the larger you are, the greater the tax savings, and it looks even better. It's more of a no-brainer, the higher business value as you go up the ladder. All right, this is that shortcut I talked about. I used to think that it was federal ERISA law that I had to diagram an ESOP. And for those of you expecting one, I'm sorry about that. I'm not going to diagram the ESOP. We can certainly do that. I have plenty of wonderful graphics I can send you. It's really great. But let's talk about it conceptually. And this is how I explain it to the client. They don't care about the boxes and the arrows. They just want to know, generally, how does this thing work? And I explain it this way. It's really just the first 4 bullets. ESOP borrows money. Let's just think a bank in our head. It's a combination of bank and installment notes, but let's just think bank for a second. ESOP borrows money. ESOP uses that money to buy the stock from selling shareholders. The company makes annual contributions to the ESOP. The ESOP uses that contribution to pay off the debt. And I'll tell you how we get where we come up with that money in a second. So this summary: ESOP borrows money, uses that money to buy the stock from selling shareholders. The company contributes money to the ESOP every year. It's deductible. And then the ESOP uses that to pay off the debt. It's not as difficult as people, conceptually, it's not as difficult as some people try to make it. And then the shares that the ESOP buys are put in employees' accounts over a 20, 30, 40-year period. We kind of back into that number. We put on our employee benefit hat. How much is too much of a benefit? How much is too little? So it's not all handed out day one, because what happens if somebody's hired tomorrow? Sorry, should have been here yesterday. We had free beer yesterday, no beer today. No, it's spread out over a period of 20, 30, 40 years. So it's a recruiting tool. Hey, come work for us. Work a long time. Every year you're here for the next 37 years, you're getting shares. Love to have you. And then when the employees cash out their stock balance, their vested balance, when their employment ends, just like any other qualified retirement plan, they die, become disabled, retire, whatever the case may be. But here's a planning point for advisors. The company must make a market for the stock for the exiting employees. You can't just say, hey, here's our company's stock. Good luck. I hope you find somebody to buy it from you someday. No, the company must make a market for that stock. And when I started my career at good old General American that had a little bump in the road and then MetLife, the purpose was of the program was to fund this liability. At the end of the day, the employees have stock and they get the cash out. So how does the company prepare for that? And that's and we'll talk about that a little later. But here's a hint: corporate-owned life insurance is beautiful there. All right, there's some major tax advantages of ESOPs, and I'm going to touch on two of them primarily because this is what drives ESOPs these days. The first major tax advantage of an ESOP, it's like a 1035 exchange for insurance. I'm sure you're all aware of that. But it's the indefinite deferral and elimination, eventually, of the capital gains taxes that are normally due on a sale of a business. But that's available for C Corps only. And as we both know, most companies are pass-throughs of some sort, an LLC or an SCorp. And so they'd have to convert to a C Corp. And I know there's some issues to that. But the indefinite deferral and elimination of capital gains taxes is pretty huge. It's like a 1031 real estate exchange. You have an old piece of land, you sell it and buy another piece of land. You don't have to recognize a gain regardless of the tax basis. Life insurance, right? Have an old policy, a better one comes along and you sell the old one, you drop the old one, buy a new one with like person, same person. You don't have to recognize a gain, and the tax basis flows through to the new policy. It's just like the tax basis of the original land became the tax basis of the new land you purchased. Likewise, if you sell stock of your C Corp in the United States and you sell it to an ESOP and you reinvest it in other stocks and bonds of US domestic companies, you too can transfer the basis of this cement company with a wheelbarrow that started with a wheelbarrow and a bag of Quikrete with a basis of $200. Now it's a $30 million business. That'd be a huge capital gains tax. And as you know, in Kathleen's wonderful presentation, Kathleen Bilderback's wonderful presentation yesterday, they're expecting capital gains to go to probably 25%. Biden said President Biden respectfully originally said he wanted to double capital gains taxes. So I guess it'd be good if it was only 25%, but capital gains tax rates are going up. I think everybody believes. And so the conversion of other type entities to a C corporation may happen a lot more to get this tax benefit in the future. Versus today, a lot of people are thinking, hey, 20%, it's the lowest we're probably ever going to be. I might as well eat it and take advantage of the other major tax advantage of an ESOP, which is an S corporation ESOP. You've got to be one or the other. Get this. This is a true statement. Profits of 100% ESOP-owned company become 100% federal and state income tax exempt. Profits aren't taxed on 100% ESOP-owned S corporation, in other words. The tax literally goes away. And it's frankly, you're probably saying, Dan, you're crazy. That can't possibly be. But no, it's absolutely true. And it's a simple function of tax, how tax works. An S Corp's a flow-through entity. It's a pass-through. So the owners of S Corps get a K-1. They get the tax form every year. They file a 1040, right? And take distributions from the company to pay their tax. That's how pretty much every pass-through works. You earn profits, deduct what you can, you get a K-1, you file a 1040, and you take money out of the company in the form of distributions to pay your tax. That's what happens. Well, what if the ESOP owned all the stock? ESOP's a qualified retirement plan like a 401k. Does a 401k pay income tax? Absolutely not. Neither does an ESOP. It's a qualified retirement plan. So the K-1 goes to who? It goes to the ESOP. The ESOP doesn't pay tax, so the company says, we no longer need to declare distributions because our one and only shareholder, the ESOP, doesn't pay tax. So all that money that used to go out the door in distributions so the owners can pay their federal and state income tax now stays at the corporation. And that's the money we use to contribute to the ESOP every year so the ESOP can pay off its debt. That's the found money. Depending on the state, we've just increased the cash flow of the company 35 to 50% or more. And that's one of the key drivers of ESOPs here. But going forward, based on what rates may be, I don't know. We might have companies saying, let's switch to a C Corp. But here's the rub, and a lot of you might know this. If you do switch from a C Corp, from an S Corp or most other entities to a C Corporation, you have to remain a C Corp for 5 years. So that's the rub. I can switch to a C, potentially defer and eliminate the capital gains taxes, but I have to pay federal and state income taxes as a C corporation for 5 years before I'm allowed to switch back to an S. When you could have been tax-free for those 5 years, you're paying federal and state income tax on profits as a C corp, which is why at a 20% bracket, currently people are saying, I'll eat the 20% because I'd rather be tax-free for this for those 5 years and then beyond. So that's going to be the rub, right? We're going to have to figure this out. And this is where going to be a lot of planning that need to be done going forward. But the good news is there's some, both are good tax advantages. And about 20% of the time, we can find an exception to the rules and get both. We go to a C Corp, get that tax advantage without the 5-year wait. There's some holding company structures and some different things we can do if it makes sense. And we always look at that. And there's other good news, I guess. There's every session of Congress, there's pending legislation to kind of merge those two benefits because the law just never caught up. And so you have to make a choice now. People are saying, well, if it's a good thing, why are we making people choose? And at one point, 34% of the Senate split equally party-wise were co-sponsors of the bill that would merge those two and have businesses not have to make that choice. We're just all hoping in the ESOP community that happens finally. So nobody's really talking about it right now, but it's going to come back up. I can almost guarantee it. And you'll see this a little later, but at this point, it's very significant state and charitable planning opportunities when you do an ESOP, and I'll point those out later when we get there. This is the section, I kind of put some of these slides in to kind of just give you some backup. So if you want the presentation, you can have it and just some more meat behind it. But IRC Section 1042 is that provision, like a 1031 or like a 1035, that says if you sell your stock of a C Corp to an ESOP, you reinvest your proceeds within 12 months into what's called qualified replacement property, which is US stocks and bonds with some caveats. And there are some special ESOP financial vehicles out there in the financial world to facilitate the deferral and have access to the cash. You're not locked up in those securities forever because if you do sell them, you pay tax at that point. It's a deferral. But these special ESOP vehicles make it so you get the deferral and hope in the stepped up basis of death, which is still the law, despite some rumors that step up basis of death might go away. Most people that I talk to feel that's not going to be in the final. And so we hopefully still get the stepped up basis. So you die with the vehicles in your portfolio, get a stepped up basis of death, yet have access to about 90% of the value of those investments, free and clear to do whatever you want with it. So that's 1042. The SCorp, I kind of think I talked about this already, how it worked. It's just a pass-through entity, and the pass-through entity and the tax form ends up at the ESOP, which is tax exempt. And so no taxes are paid, therefore no distributions are made. The company increases the cash flow, and then that's what's used to pay off the debt. I did have a diagram. It's not a total ESOP diagram that I thought was federal law. It's just a diagram of how S-corps are normally taxed. It just shows the pre-ESOP, somebody's paying tax, distributions are made to pay tax. In an ESOP, the CPA still prepares the K1. The K1 still goes to the shareholder, but pays no tax. You file a 5500 and then no distributions are distributed because the sole owner doesn't pay tax. So Kathleen, yesterday's presentation talked a lot more eloquently about about the tax situations. I think the bottom line is the taxes are going up probably. I think everybody agrees with that. So we may be looking at a 25 plus the 3.8 of an effective capital gains rate of 28.8%. So assuming a $20 million business sale with a zero basis, the federal capital gains tax would increase $1 million from 4.76 to 5.76 million dollars. That's a 21% increase in capital gains tax. That's significant. And plus there's state, right? It was too hard to kind of factor all that in, so I stuck at the federal, but the average state capital gains tax is about 5%. And so the expectations are that a record number of sellers are going to consider converting to a C Corp and taking advantage of that 1042 capital gains tax deferral, which led to the article in Forbes Online magazine in March. The combination of factors the greater awareness of their benefits and an environment encouraging their use may combine to make the 2020s the decade of the ESOP. And we believe that to be true. So I suggest you kind of stay on the leading edge of that. Now, another thing, this kind of stinks too. That was the capital gains tax side. This is the income tax side. When the Tax Cuts and Jobs Act happened, it lowered the top federal rate from 35 to 21, which businesses love. Now, from a valuation standpoint, all valuations value a company as a C-Corp for uniformity. Just so you have an equal measuring stick. So every business, whether an S, LLC, whatever it is, for valuation purposes, you convert them to a C and do the valuation assuming a tax rate. When a tax rate went down, that increased profits across the board to the companies because their rate went down, they kept more. Therefore, values went up instantly. So business values after the Tax Cuts and Jobs Act, values instantly increased 8 to 12% across the board. And under President Biden's proposal, if federal corporate income tax raised from 21 to 28, that's about a 33%, a third increase of the federal corporate income taxes. So therefore, business values will necessarily decrease accordingly. So business owners are kind of getting double jeopardy here, right? They face a double whammy in regards to the proposed capital gains and income tax increases. Business owners' value and therefore net worth will necessarily decrease with income taxes. And then sellers will pay more tax on what they get. Now in green, because it's good, unless they sell to an ESOP to defer and eliminate the capital gains tax altogether. So yes, they may get a somewhat less value because of the income tax side of things, but with the 1042 of an ESOP, we don't have to worry as much about capital gains tax, whatever they are, if we defer them and eliminate them altogether. That's the good news. That's the talking point. Okay, we get questions about control a lot. This is what business owners really want to know. Who's running the company? If I sell more than 51%, are my employees voting to tell me what to do, and can they fire me? And the answer is actually absolutely not. Employees have only a beneficial interest in the ESOP, not actual stock. So they don't have statutory minority shareholder rights. If I own one share of somebody's company, I have a right to certain information so I can make sure I'm not getting taken advantage of. Employees don't have rights to confidential payroll information, list of biggest customers, the benefits that the execs get. They do not get that. Because they only have a beneficial interest. And there's a trustee who votes the shares on behalf of the employees. Now, you say, okay, so this trustee can fire me. Well, the trustee takes direction from the board. The trustee does technically own the stock and does technically vote the stock. ESOP trustees, it's a special world, special universe of ESOP trustees out there. They are trustees of dozens, if not hundreds of ESOPs every year. They have zero desire of running a company. They don't want the legal liability. They'd rather have the board take that legal liability, and they take their direction from the board. The trustee just makes sure they're not violating ERISA law and the employees aren't being taken care of. So really no risk of losing position unless they're breaking the law. And that's happened in my career. We've done hundreds of ESOPs, had to fire one selling shareholder who was remaining on the board because they was embezzling money. And not an owner, you lose your piggy bank that way. We kind of kid around and say you lose your thieving rights. You sold the company. There's a couple million in there. You can't just reach in and grab it anymore because you don't own it. The employees do. And so if a selling shareholder who remains on the board and sticks around is caught putting their hands in the cookie jar against the terms of the sale and against the employment agreements, yes, the trustee might have to fire them. But that's the rare situation. One in my 22 years, we had to do that. That's because somebody was stealing. And as I mentioned, the seller and the family can stick around as long as they want. They can remain president, chair of the board, CEO, receive salary, perks, benefits, cars, phones, healthcare, still receive all those things just as a top employee. And they'd get a compensation package equivalent, they'd get the package that somebody else in that same position would get at an ESOP or non-ESOP company. And so when the seller says, you know what, I'm tired, I got paid my money now, I no longer want to be president, or I no longer want to be CEO, I want to name my daughter, my son, or my key manager, they can do that at that time or they can just sit in those roles forever. It's completely up to them. They can pass the baton when they choose to do so. We could talk a lot more about control, but I think we covered that because your client wants to know, do I lose control? And the answer is no. And that's one of the big myths of an ESOP, that they lose control. They say, I don't want to sell 51% because I'm going to lose control of my company. My employees are going to tell me what to do. That's absolutely false. That does not happen. So kind of nip that in the bud. Valuation. How does the company get valued and what do I get? I heard I don't get as much for an ESOP sale. That's not true either. Yeah, there are some certain circumstances where you might have private equity or somebody with silly money coming in to strategically buy somebody. Yes, that will beat an ESOP or any other financial buyer, most likely. The ESOP is a financial buyer, and the company, the seller hires a seller side valuation firm. That's what part of what my firm does, but the seller will hire their own valuation firm. The trustee will hire their own buy side valuation firm. And then there's a true arm's length negotiation. The seller side team and the trustee side team literally negotiate an arm's length. We don't see there. The seller side doesn't see the buyer's valuation, and the buyer side doesn't see the seller side valuation. And it's a true arm's length negotiation. The kind of a nice thing is ESOP valuations are very forward looking. We take into consideration heavily forecasts. So if a company is looking good, ESOP will do a discounted cash flow and looks a little more favorably from, in my opinion, than other valuations that are done for a buyer who's trying to downplay things like that. The seller side, the trustee is willing to look at what they're buying, and it's a dang friendly negotiation, I have to tell you. Because the trustee wants the employees to have stock. They just want to make sure they don't overpay. So if the Department of Labor came in, they could say, look, here's the valuation we had done. Here's all the answers to the questions we were asking, and here's our file. We feel very comfortable paying this amount of money for this company. And in all my years, in my 22 years, I've had one time they couldn't come to an agreement. And frankly, the trustee side was correct. It turned out the seller was hiding something, and they found out about it before we did. So anyway, so that's the one time. And ESOP does have some very specific discounts. Like I'm just going to throw this out there, but not explain it. Every privately held sale, every private company sale faces potentially a couple discounts. If you sell less than 51%, you take a minority haircut. And a privately held company that doesn't have a ready market usually has to eat a 20 to 25% marketability discount, which is negative. In an ESOP, that marketability discount's only 5%, because the company must buy back the shares when the employee leaves. So there is a federally mandated market for the stock. So that valuation discount's only 5% versus 20 to 25% in any other private sale. All right, how do we finance it? How do we do this? Well, I told you how we found the money, right? We're not paying federal and state income taxes. That frees up a lot of cash. And more often than not, that total tax savings is greater than the sale price during the terms of the financing. So we generally do bank financing and seller financing. It's a combination, but we give significant incentives to the seller for doing that. You might say, why would I do that? Well, kind of make some lemonade out of lemons. Let me tell you how. Now, we could finance 100% if we wanted to. I'm not saying to do this. I'm saying this is kind of a benchmark. I'm going to say I'm setting the stage for a better thing. We could find somebody that says, yeah, the bank's going to lend maybe 1.5 to 2.5 times the EBITDA. You know, that their earnings we talked about earlier. So maybe 40 to 50% of the value of the company. The senior lender at 3 or 4% is not going to lend much more than that, generally, without significant collateral. But that's usually where we end up. There are lenders that said, hey, I'll sit behind the bank. I'll be interest only. I'll only get paid if the bank gets paid. I'm happy to do that. It's a nice aggressive investment for me, but I need 10 to 12%. I'm not doing it for 4% like the bank. Why would I? I'm subordinate and I'm interest only until the bank's paid. And so therefore they deserve a higher rate of return. So, okay, fine. That kind of stinks, that going out the door, but we say, don't do that. We say to the seller, look, seller, you be that mezzanine, you be that subordinate lender. You take seller installment notes, get your money over time, maybe over 6 to 8 years. We're going to pay you over time for anything above what the bank lent you originally. Now, the seller is entitled to a market rate of interest. So then the question is, what's market rate of interest? Is the seller entitled, is market rate of interest what the bank lends with security and collateral and first position, or is market rate of interest what another mezzanine or subordinate lender would charge, that 10 or 12%? Well, the answer is the later. And so market rate is what any other, you, me, or anybody else would come in that situation and lend. So that's good news. The seller can get that 8 to 10 to 11% total return. So then the question is, well, how do we do that? Do we just give them 10, 11%? Is that the most efficient way to do it? Generally not. And there's some problems with that, of course. Nothing's simple, right? The objective here is we're trying to get the total rate of return. And so how do we do that? Simple ways to give them the 11%. But trustee doesn't like it. It hurts the stock value growth. The bank doesn't like that much interest going out the door, competing against their ability to pay back their loan. They're very protective like that. And I understand that. And from our client's standpoint, interest is taxable as ordinary income. So depending on your state, you can lose up to 50% of that high interest rates going right out the door to federal and state governments. So what can we do instead of just paying that 10, 11%? Here's what happens in ESOP land. This is Main Street. This is 75 to 80% of all new ESOPs from any provider throughout the country. The seller says, look, I'll take what the bank's charging. I'll take that lower rate. I'll pay tax on that, ordinary income, that's fine, but I'm leaving something on the table. So we tell the seller, take the 3 to 5%, trustee's happy, bank's happy, your tax burden's going down a little bit, but you're owed something. So to reward them for taking that lower rate and being interest only and subordinate to the bank, we give them, in addition to 100% of the value that they're going to get for the company, they get an additional 20 to 25% of whatever the then value of the company is the day all the debt's paid off. So that's an additional payment. They've already gotten 100% of the value of the company, maybe half from the bank, the other half at 4%, when they had 100% of the value paid out from the sale price that we agreed to. Then they get another check of up to 20 to 25% of whatever the value is, that date and time, 100% had been satisfied. That's an additional payment to them to reward them for bearing that seller debt. Sellers love it. Like I said, it's their baby many times, right? They sell 100%, but they still have an equity stake in this business. Even though they sold it and got 100% of the value, they get more money. And so it's in the form of warrants, just to be technical there. It's warrants, which is just simply a future equity stake of the company, and with a very, very, very low strike price for you technical people. Because warrants is the ability to buy stock later at a price that we established today. Well, the strike price is the value of the company the day we leveraged it 100%. So if you buy a house and you borrow 100% of the value, what's your equity value of your house that day? 0, right? Well, virtually the same thing in an ESOP. If your strike price is the value of the company the day you leveraged it 100%, it's not quite 0, might be 5% of the original value, maybe 10 on the high side. But so you have very low strike price, and they get to use that very low strike price to receive an equity stake. The value of the equity stake, not the actual stock, you get the value of 20 to 25% once all the debt's paid off. So in theory, the value should be at least where we started if there's no growth. Plus, this tax-free company is growing pretty substantially, right? Common sense, tax-free companies grow faster than taxable companies. And so that 20 to 25%, probably not on the original price, it's probably on a substantially increased price over the period of those seller notes being paid. Here's just a total outcome example. Let's say we had $20 million sale, and we got the bank, we got 40% from the bank, that's $8 million. Now that $8 million, how's that taxed? Well, it could be taxed as capital gains, or it could be taxed not taxed at all if we exercise 1042. The seller note principal, 12 million. That's taxed as capital gains or not taxed at all. The seller note, at a reduced rate of, in this example, 4.5%, another $4.5 million. That's taxed as ordinary income, unfortunately. And then the warrants, the future equity stake, almost another $8 million. And that's taxable as capital gains, not ordinary income like the interest is. So we even changed the tax nature of that reward for a total of over $32 million in this example. It doesn't always take 15 years. This client wanted, they had no plans of going anywhere and they had children in the business. They wanted to extend the growth of this tax-free company. So when they got their 25%, it was maximized. That's why this family chose a 15-year period. It's often done in 6 to 7 years. But the future equity stake would be a tad lower because it didn't have as much time to bake. Wish I had time for questions. I'm going to keep chugging along here. Now, as far as I'm just going to touch on this, whet your appetite. Maybe we could do another presentation in another year on ESOPs and estate and charitable planning. Now, just the low-hanging fruit, quite frankly, is gifting those financing vehicles, right? I mean, those warrants, that future equity stake. Remember I mentioned the company is so devalued at that time, discounted 90 to 95%. So you could gift away the warrants you can gift away up to 25% of the value of the company for very, very little gift and estate tax consequence. You figure if you have a $100 million company and you're going to gift away $25 million, that's what it's going to be worth in the future or even more because it's going to grow. But you can gift it away under your exclusions and your lifetime exemptions for 5% of $25 million. That's pretty incredible. That's leverage, my friends, right? That's some transfer of wealth at an incredible discount. And likewise, the seller notes themselves. I've heard they're discounted. I'm not a valuation person myself. I heard they're discounted 40 to 60% because they're interest-only subordinate seller notes at a below market interest rate. So you could gift those away, great discounts as well. Those are the estate planning things there. And one other thing here, just for charitable purposes here, people donate appreciated stock to charity so they don't have to pay capital gains, right? That's why people do it. People donate cash to charities because you get a higher deduction. You get up to 60% of AGI for 5 years with a carry forward versus the deduction of appreciated stock where your deduction is 30% of AGI for 5 years. So doing an ESOP, electing the 1042, which is the capital gains tax elimination, and then donating those untaxed proceeds to the charity, you get the best of both worlds. You have no capital gains tax like an appreciated stock donation, but you get, because you're actually contributing cash, you get twice the income tax deduction. As far as I know, it's the only way you can do something like that. And then people smarter than me use grats and gruts and crats and cruts and all those different things that you probably hear in presentations on. They're very, very applicable at these when the ESOP is being done as well. Okay, the objections I get, hey, they're complicated. Yeah, there's some complication to it, but man, every presentation in this 3-day impact week have some complication to it, right? And very, very worthwhile techniques if you have the right advisors and with you involved, they do. I hear they're expensive. Well, that's relative. I mean, private equity ain't cheap. Other outside sales, business brokers, they're not cheap either. It might be the biggest consulting fees that your client has experienced thus far, but compared to the M&A world and compared, and it's relative, and compared to potentially not paying capital gains and not paying income tax ever again. So to pay hundreds of thousands of dollars to do an ESOP, is it really expensive compared to the benefits and the alternative costs of selling your business a different way? It's relative. ESOPs generally, in my experience, are considerably less than some of those outside sales. Employees will run the business. That's absolutely not true. We talked about that earlier. I hear ESOPs are difficult to finance. That's not true. Banks that know what they're talking about, and there's many, 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 many of them, they love lending to a company not paying income tax, right? The ability to pay back is a lot greater than if the company's paying tax. So with that being said, let's switch gears here. That's kind of the ESOP structured. Let's move into planning needs. all the needs. I mean, everything. We opened up a can of worms here to the positive, right? We have charitable, executive benefits for key executives. The trustee may require. They always require management agreements, employment agreements, and usually you need to incentivize them with some kind of executive benefit. It could be deferred compensation, a SERP. It could be often in ESOP world, since it's being valued every year anyway, we use stock appreciation rights or phantom stock, because you can tie it to stock value growth, which everybody likes, especially in an ESOP scenario. We during their succession, there might not be 100% ESOP. You buy sell agreements. Now, one of the big things is the corporate repurchase liability. I touched on this earlier. This is the legal requirement of the company to buy back shares when the employees leave. We sell $50 million of stock to an ESOP. That company is buying back at least 50 million plus growth over time. Plus the shares, when they're repurchased, usually get put back in the ESOP and recycled. The companies have to buy them back again. And so that really never ends. And the liability is not that big up front, but it gets big later when people are vested, when the shares are handed out and the stock value grows because the debt's been repaid. It's a great time for corporate repurchase, for corporate owned life insurance to bake in the early years when the need's not that great, but then have death benefits and cash values to come into play in the later years when the liability really gets big. Obviously, the wealth management, probably the lowest hanging fruit, right? We liquidated a $50 million company, maybe get half of that up front, assets under management, the other half over a period of time. You're going to take over the 401k if you don't have it now. If you're a banker, you're doing financing. So there's a lot of things there. So for the insurance side, I'm touched a little bit more here. Benefit to the advisors. We almost always do key person insurance on the selling shareholder and the top execs. That the corporate owned life insurance for that repurchase liability we talked about, and also wrap in that corporate owned life insurance for whatever executive benefits we put into play there. And plus, we just opened up the world for your second to die policies, your ILITs, your charity policies, whatever you want to do, family estate stuff. We just opened up the world. We have found the money to do it. And they have wealth and they need to protect it. And you know the best ways to do that. How about the wealth advisor? Well, this was I have a case study in the back, and so this is still in here, the numbers, but wealth manager on my case study, we may not get to though, got 9.5 million AUM, assets under management up front, another 14 million over 8 years. And then when that's future equity stake for bearing the seller debt came into play in year 8, got another $7.4 million. Those assets under management were very nice for that advisor. Plus some like to use a combination of insurance and investments to pre-fund that repurchase liability. And then remember, when that money comes out of the policies you sold them or out of the investments that you sold them, that's all qualified rollover money. You get it again. So when Susie and Tommy leave the company, you take that money and roll it into individual IRAs for them. And so that keeps going. And remember, that employee is worth 2.5 times non-ESOP employees. So it could be quite lucrative. Then I have my banker friends, my attorney friends, my accountant friends. Banker gets the loan, refinances the seller loan notes usually, and then gets the loan to finance that future equity stake. So the banker has 3 consecutive loans if they want them. The attorney, there's many corporate reorganization, bylaws, amendments, all kinds of corporate documents that aren't even really ESOP documents. If that law firm does ERISA ESOP work, they can get all that as well. But oftentimes that's not the case. You bring in a hired gun just for the ESOP because there's specialists in there, but you don't have to. And then you also, the attorney and the accountant especially, if a company gets sold, chances are you're not the attorney or the accountant post-transaction, right? We've all felt that pain. They get sold, you do lose the client. So not only if you do suggest an ESOP and they do an ESOP, not only do you retain the client, you gain a client because the ESOP is pretty labor intensive for both accounting and legal work. So the accountant gets, forecast, reviewed and audited financials, quality of earnings reports, all kinds of stuff, ongoing forecast in the financials. So there's a lot of work for advisors there. Carla, can you tell me how much time I have?
You have another, call it 13 minutes.
Okay, great. So that takes me to 50. Okay. What to ask for the advisor? I get to ask this a lot. Okay, great, Dan, thank you. What do I do now? Well, here's some of the questions. And I heard on the end of Steve's presentation, SB, some of the questions to ask. And I agree. Just start asking open-ended questions, right? But for ESOP purposes, simple things like, have you considered how you're going to cash out the value of your business, right? Do you want to just, oh, okay, do you just want to give it to your children, right? Okay, great, that sounds good. So how are you going to do that? Are you just going to give it to them? Or do you need some of the value? Well, yeah, I kind of need the value. So, okay, so how are you going to do that? You're just going to pay, they're just going to pay you the rest of their life? So can the children run and grow the company with you taking cash out every year? How long do they want to do that? They want to, you give them the reins and their hands are tied. Do you really want to do that? Do they want to do that? You know, maybe they say, no, thanks. I don't want to do that. Find somebody else. Do your key execs have the ability to buy you out? Let me give you the answer. No. Or can they obtain financing? Sometimes. Most likely you're at least partially going to be the bank. Do you want to be your employee's bank? And if they screw it up, you don't get paid. And quite frankly, key execs, even if they could obtain financing, when they go home and say to their spouse, hey, honey, got great news. I'm going to buy the company where I work. And I'm putting the house up as collateral. We're digging into our 401, we're cashing out our retirement plans, and we're putting up our investment portfolio as security because that's what the SBA wants. Is that all right with you? I'll tell you what the answer is many times. It fails at that second. That's when they say, okay, the managers couldn't do it, or they weren't willing to do it. What's the next thing to do? And that's often the ESOP. And also, hey, are you worried about the fate of your employees? If you sell to an outside buyer or private equity, what happens to them? You know, chances are your C-suite's gone. And I've seen many scenarios where, you know, they say, we're taking the patent, we're closing down the manufacturing plant. Or, hey, good news, bad news. Good news is y'all have jobs. Bad news is y'all moving out of state. That's what happens. That's common. I had an owner one time later, did not do an ESOP, but I knew the guy. He said, I should have done that ESOP. I said, yeah, I know you should have, but why do you think you should have? Because, hey, I sold my company. First thing I did was buy a brand new Cadillac, drove it to church on the Sunday after the sale, or a couple months after the sale, drove my brand new Cadillac. I sat next to my employees. A couple of my employees were in the same pew as me, and they had all just got laid off. So here I am driving away in my brand new shiny Cadillac, and these people are out of work because of me. You know, so the employers that that care about their employees really should at least hear about an ESOP. It should be on the list until it's crossed out. So what do you say? You know, those are some questions. What do you say about an ESOP? We say, hey, ESOPs is a buyer. It's just another buyer. You know, not a lot of people know about them, you know, or I shouldn't say it that way, but, you know, it's not talked about enough. It's an alternative to selling to outsiders and private equity that aren't going to maybe treat your employees the way you would have. ESOPs preserve jobs. That's why there's so many tax advantages that are given. And it preserves your legacy in the town for the reason I just talked about. And they're very favored by both parties. They offer significant tax incentives for owners to sell to an ESOP, to both the company and the seller. Get some really big tax breaks. And it allows the owner to get full fair market value. You're not taking less, what you might have heard, and potentially tax-free. You get to work there as long as you want, remain in control, and pass the reins to whoever you want, when you want, including your children. So you can see why it'd be worth investing like an hour just to hear what it's about before you cross it out. And then additionally, what to say, look, I know I just gave you a lot. Seller, there's some reasons there. There's some good tax advantages, but it's kind of, there are some technicalities to it. And there's a unique set of rules and procedures that we kind of have to follow. So it's highly recommended that you involved an ESOP specialist from the beginning to answer your questions. And so maybe saying, you know, I, my firm, and my affiliations, fill in the blanks there, do what we do very well. We invest, we insure, we advise, we do these things very well. But when it comes to ESOP, we use these specialists to help them through the ESOP process. And our firm has a relationship with, insert your favorite ESOP consultant, that we connect with our clients to provide the best-in-class service for our clients, because it is a specialty. Would you mind if we set up an appointment? You can do it by Zoom, just to see what an ESOP is. And if it doesn't make sense, hey, we gave up an hour, we learned something. But if it does make sense, then maybe we can take a look at it. And the general process is like this: education and research. We have a client version of this that's pretty simple, answers their major questions. Then we go to a feasibility study or something similar to it. It's the blueprint for implementation. We identify the financing. It's all the cash flow analysis, all those kind of things. And then at that point, go to implementation if the blueprint looks satisfactory. If it's not abundantly clear that an ESOP's the best choice, you stop after the feasibility study phase. But if it is abundantly clear, then you move on. You hire the trustee team, the trustees council, trustees evaluation firm, the ERISA, ESOP council, And then you need a sell side consultant like my firm and other firms that are the quarterback and the valuation firm for the seller. So that's the general process. Everybody tweaks it a little differently, but it's not, here's ESOP 101. Do you want to do an ESOP? In fact, there's some other checkpoints along the way here, like on the education side and even before the feasibility. It's what we do. I imagine other firms do as well, but that's the general process there. So I've coined the phrase, wrote an LinkedIn article, the ESOP opportunity zone. ESOPs are becoming more widely known by the advisors and the public. They just are. Lots of opportunities for professional advisors to participate in the transaction. We talked about those. I just touched on some of those opportunities for advisors to advise and offer some products and services. And I say, you don't have to change your practice. Just ask some of those additional questions, get the appointment right. It builds really strong relationships with your centers of influence. I'm sure you have very good relationships with your centers of influence, but I have found, even from the most seasoned and aged and great advisors, that adding ESOPs to an offering that you could bring to their practice as a turnkey, whether it's my firm or another firm, there's people, just have a go-to, have your ESOP person and say, look, I can bring to you an ESOP package. So you don't have to go to the attorney down the street that did one ESOP in 1974. You have ready-made ESOP package that you can bring to them and say, look, I'm here. We'll help you educate. We'll look at the financials, make your, give a review of their financials, sign NDAs and all that kind of stuff. We're bringing this to your practice at no cost to you. And it's very powerful. And so my question is, are the 2020s the decade of the ESOP and your ESOP opportunity zone going forward? I hope so. There's my contact information. Now, Carla, I have 5 minutes. I don't know if you'd like me to answer questions, and I do have a case study that would be a challenge to get through in 5 minutes, but I could. Or do we open up for questions? Carla, you're muted.
I am so sorry. You've got 15 minutes
Oh, I do
left. So if you want to do your case study,
okay,
feel free.
Let's do it. Let's do it. Look at that. I have one right there. What a coincidence. Okay, we have a manufacturing company. It was a C Corp, which is a little convenient, I guess, because I didn't have to worry about converting them from an S or another type entity. But this is a true case study here. We have a manufacturer. Oh, and by the way, manufacturing is the largest category of industries that do ESOPs. It's by far the leading, I guess, generic industry, all types of manufacturing, followed by like engineering, the technical services, financial firms, engineering, architecture. It can't be a company that's a professional corporation. You've got to be a true C or true S. There are some exceptions there, but 99.9%, you got to be an SCorp or a C Corp. So then you have the manufacturing, then you have the technical services, you have construction, and you have then followed by that is pretty much all the blue collars. A lot of the blue collar type firms really like ESOPs because it's tougher to sell sometimes, and ESOP just fits. So a little background there. I don't have those slides in there, but just want to tell you that. So we have a manufacturing company. It's a C Corp. Business value was $23.5 million, had 55 employees with $2.5 million of payroll. And we had a 64-year-old owner in fair health and a key manager willing and able to run the business, but lo and behold, cannot afford to buy it, which is the usual story. The goal, seller to transition of the duties and titles to the key executive immediately, but very smart and based on a recommendation, remain chair of the board until substantially paid, right? You don't want to just turn it all over, check out, and not come around anymore. I don't care if it's your kid or your key manager. You want to make sure you stick around in some capacity, chair, maybe CEO, something to your substantially paid. And sometimes you make a deal with your key managers. Look, when I'm gone, when I'm paid, when I'm 80% paid or I'm 100% paid, I agree to, I will back out completely. And you will then be president, CEO, and chair of the board. I will no longer have stick my nose in the business. I'll be paid and I'll be gone. That's a heck of an incentive for the key executives, right? To work hard and pay off the seller especially because they have ESOP shares themselves. And they know as soon as they're paid out, they can grow the value, they get him out, then all of a sudden they get the salary of president, CEO, and chair of the board too. That's very attractive. The seller wanted to gain estate liquidity. This certainly does that. Concerned about, recruiting and rewarding long-term employees, and really wanted to secure the business continuation. He had quite a legacy. This was an Arizona case. It had a real nice reputation in the town, and really wanted to not only protect the employees, didn't want to be bad mouth. And frankly, business started by this guy's father. Thinking about what happens if somebody else, private equity, comes in and takes down his father and grandfather's picture that was hanging in the foyer, right? That's concern about that. And obviously, love to reduce personal and corporate taxes where possible. And lo and behold, we can find an answer for him, right? Well, the solution was we did 100% SCorp ESOP. We elected the 1042, which is the capital gains tax deferral. We borrowed $9.5 million from the bank at 4% for 5 years, and that's a typical term of 5 years. Seller received $14 million in subordinate seller installment notes. It was for 8 years, and it was at 4%, not the mezzanine rate that it would have been of 11.2% was the going rate at the time. So he accepted 4, but remember, you can tell me now, right, that we had to replace that. We gave up something. We owed 11.2, we took 4. So we rewarded that seller for bearing that subordinate interest-only below market note. And the company will take an S election within 75 days of the next tax year, because they were already a C. They didn't have there's no weight going to an SCorp. So they take the SCorp election within 75 days of the next tax year, and now the profits cease to be taxable as well. So that's what we did. And all the benefit to the client, seller received $9.5 million cash at close. The seller is receiving it's in the process, receiving $14 million over 8 years. Good chance that the bank's going to refinance that, so he doesn't have to wait all 8 years. The seller deferred and eliminated almost $5.6 million in federal and state capital gains tax rates. Seller will receive an estimated additional payment that the seller notes, the future equity stake in the form of warrants, the in-the-money amount, get another $7.4 million estimated, and that's taxable as well. I'll talk about that in a second. So total estimated payout to the seller, about $33.6 million on a $20 million company. Now, how's that taxed? Let's break that down. $23.5 million non-taxable, because we elected the 1042. So we saved a whole bunch of capital gains tax there, especially going forward, right? Knowing what we think is going to happen. 7.4 million of taxed as capital gains. That's the future equity stake for bearing the subordinate debt. That's taxed as capital gains. Whereas if they would have taken the interest rate of 11.2, that would have been taxed as ordinary income, and we lost almost half of it. So under current rates, that's a good thing. We half the tax rate too. And then 2.7 million is taxed as ordinary income, and that represents the interest on interest at 4% that the seller agreed to take. And the seller was thrilled that the family and community legacy is still intact, still donate to the Boys and Girl Scouts, to support the baseball team. A father and grandfather's portrait's still in the foyer. Some employees that have gotten raises every year for the last 30 years are not getting a pay cut that private equity would have done. So he was very happy about that. So that's the result there. What we did now, what I don't have here, and I thought I had a slide, is all of those items I talked about, the opportunities for advisors in that scenario. The wealth advisor invests ultimately $33 million, or subtract the tax, it was like $30 million after you pay the minimal tax. The life insurance advisor sold some big COLI policies, very big COLI policies, annual reoccurring in the millions, ongoing premium. We did stock appreciation rights in this scenario. And in addition to funding that repurchase liability, which is the obligation to buy back shares from exiting employees, we just increased the COLI to cover the projected payouts to the key execs for the stock appreciation rights. This advisor did, I believe, a second to die policy for estate planning purposes, did some charitable, it's a textbook case, and did all those things. The attorneys did ERISA work, did the drafting of corporate reorganizations, stock splits, amending bylaws, stock loan agreements, pledge agreements. There's in an ESOP transaction, there's probably 20 documents for every seller that needs to be done. So there's plenty of work for both the ESOP and corporate attorney. The accountant did a whole bunch of forecasts, audits, tweaking of normalizing EBITDA, and it's going to happen every year. It's ongoing business, kind of an annuity. And then the financial advisor, the wealth advisor, obviously has the assets under management of $30-some million, but then sold either, I believe this advisor did COLI for the repurchase liability. And then when the employee leaves and we needed $100,000, the company reached in, grabbed $100,000 out of either the cash value or a death benefit that flowed in, take that money, and that's all, and the executive or the employee gets that, that's rollover money. So then that advisor rolls over the $100,000. And there have been some employees, it's been a while now that there's some balances here. This advisor is reaping the benefit of rolling over the account balances that we took out of the policies that were sold, take it out and roll it into IRAs. So the advisor is extremely happy. The client's extremely happy. And that's really textbook ESOP. And we're probably going to see a lot more SCorp ESOPs going forward. And, I'm happy to answer questions. I'm happy to talk to you one-on-one, or if you have a favorite ESOP consultant, give them a call, have some lunch. Perfect.
So this first question kind of dovetails into what you just said. Is a SCorp a better prospect than an SCorp for an ESOP?
It affords you a little better, it allows you to get the best of both worlds quicker, because you don't have a 5-year wait. If you're an SCorp and you don't qualify for the exception and you go to a SCorp to get the capital gains tax deferral, then you have to wait there those 5 years. Today, in today's environment, as tax laws today, no, people are not converting to a SCorp. They're staying the S, eating the 20% capital gains tax and being tax-free. But if they're already a C, yes, it is better, because we can take advantage of the capital gains tax deferral elimination and then don't have the 5-year wait. We can immediately take, at the beginning of the next tax year, we can take the S election. So if you have a gem of a SCorp out there, yeah, it's ideal right now. But if you're an S right now, you probably stay an S. Going forward, depending what capital gains rates are, we may have a lot more people waiting out those 5 years. And there are some very big deductions that can offset the tax during those 5 years.
Awesome. And is an ESOP a solution if the seller wants to sell immediately and does not want to work in the business any longer?
Yeah, that's one of the people say, why don't people do ESOPs? That's one of them. If they want out and don't want to have to just rely that the new management's going to meet all their obligations and pay the seller notes, an ESOP's not right. So you probably want to have your hand in there for 3, 4, 5, 6 years till you're substantially paid out. So that is one of the reasons people don't do ESOPs.
Here, we always get this question. What's your fee to the client?
Pardon me?
What's your fee to the client?
Well, you're going to get the it depends answer from me, because it depends on size and fee. It could range from 1% to 4% of the transaction inverse to size. It's no matter what, even in the smallest case, several $100,000 to get an email to get an ESOP in place.
Awesome. All right, I think, and one last question. What's your position on business owners relocating to Puerto Rico to take advantage of Act 60 to lower their federal and state taxes?
It's not my area of expertise. If that eliminates taxes, knock yourself out. I don't know much about that, I'll be frank with you.
Yeah, I thought that was an interesting one. Dan, thank you so much.
Thank you.
Here's Dan's information. If anyone has any questions, please do not hesitate to reach out. He's just a wealth of information.
Thank you for having me. Thanks, everybody. Take care.
Awesome. Thank you.